Is your P&L chaos? Let's organize it.
Welcome to the first episode of Sharpen Your Skills on 4-quarter accounting. Today, we're going to give you a very simple framework for understanding your P&L and pursuing more profit. It works like this. On the y-axis of my graph here, we have a percentage of revenue breakdown ranging from 75% to a baseline of 25% and a basement of minus 25%. Now, each of these 4 categories represents different compositions of your revenue that you will find on your P&L. For many entrepreneurs, I find that the breadth of the chart of accounts that they have make interpreting their own P&L really difficult. Well, here is an easy way you can simplify it into 4 categories to track your revenue over time.
All right, I'm interrupting this episode of 4-quarter accounting to bring you another way to save money in Q4. In reality, when I do 4-quarter accounting, we're starting all the way down here at net sales. But the reality is that there are 2 silent killers of profitability that exist before we even get to your CAC, OPEX, or cost of delivery. And it has to do with your discount rate and return rate. We know going into Q4, we're going to have to discount. It's an expectation of the customer. But how do we reduce this second one, returns? Well, looking at an example here, gross sales of $1 million, discounts of $200,000, returns at $150,000. That's 17% of your money that's going to discounts. And we've seen it be as high as 30% for some apparel brands. We know in Q4 that can inflate too because you have gifting purchases and other complications related to buying. Well, my friends at Redo have an awesome solution because a lot of times brands have to choose between, do I offer free returns or do I make them pay? Well, if I make them pay, I've seen data that says that 75% of customers say they will not buy, no buy without free returns. So what do? You either get killed in your profitability or you eat it and make the customer dissatisfied. Well, Redo offers you a solution. They enable an automated pay a small coverage fee at checkout. They auto apply it for every customer, and then that enables free returns and exchanges covered by Redo. In addition to that, they also offer you order tracking, support, as well as the ability to handle warranties and processes. So you can combine 7 different vendors from your software into one. You get free returns. And we've seen on average brands save $40,000 by switching to Redo. So combine a bunch of your software stack into one, enable free returns for your customers at a benefit to them at a small coverage fee that's auto-applied at checkout, and you're going to be saving an immense amount of money. And tell them Taylor sent you right now, and you get $100 to Bad Birdie just for watching a demo. I'm here for your margin innovation, another Q4 solution to a big problem, returns. GetRedo.com.
First begins with CAC, or customer acquisition costs. This refers to all money spent on direct response ads that intend to generate an immediate return on investment. Think of that as your Meta dollars, your Google dollars, TikTok, Snapchat, etc. Any money spent in the pursuit of direct response revenue. But this does not include any fixed marketing expenses. We'll cover that later. The second category is what I refer to as cost of delivery. This is all variable expenses that increase with order volume. If the expense goes up as orders go up, they go into this bucket. This would be your cost of goods, your shipping, your fulfillment expense, payment processor fees, if you owe a license to anybody for the sale of the product. Any number that increases with order volume is going to go into this category called cost of delivery. Your third category then refers to the opposite. If these are your variable expenses, OPEX, or what's commonly referred to in GAAP accounting as below the line on your P&L, references all fixed expenses. Rent, payroll, software, those other marketing expenses, they're all going to go into this bucket here for OPEX. And then what's left over is your profit. Now, as we examine which percentage each of these categories makes up of your revenue, I want you to recognize that it is almost impossible that each category will fall perfectly into a 25% breakdown. And I want to acknowledge that 25% is an aspirational percentage to reach in terms of profitability for e-commerce. But instead, we're going to explore a few examples of the ways in which different profitable e-commerce businesses are comprised and where brands get into trouble. Let's take a look at the first example. Let's take a brand that everybody knows, On Running, a large and profitable consumer product business. And let's understand their business through the lens of 4-quarter accounting. First, we look at profitability. You'll see it's at 9%. Their OPEX runs at 18%, cost of delivery at 40% of revenue, and CAC at 32%. So when we draw this illustration, you can see red indicates higher than standard cost, lower than standard profit, but green illustrates leaner or more efficient utilization of that product category. So this illustrates the way that most e-commerce businesses actually get to profitability. It is very difficult for a brand to actually get to the 25% benchmark around cost of delivery when you include fulfillment expense, returns, etc. So 40% is a pretty good result. In addition, you'll see the trade-off of higher CAC and leaner OPEX. This is the way that e-commerce gets the profitability. So if you were running this business and you wanted to improve against this 9%, which is still lower than we'd like to see, ultimately, we want to see this number get closer to 20%. What this visual quickly helps you to illustrate is what doors to go explore to improve. It would be hard to say that there is a lot of additional margin to be captured in OPEX because it's already more efficient than the standard. So the first place to approach would be increased efficiency of marketing dollars, or to go look at the gross margin, discount rates, etc., things that affect this number here.
Okay, quick time out for an ad read. When I went to find a partner for this series, I knew I had to find something that would help you guys at the overlap in finance and marketing. And that's where I went to Parker. And not only that, I wanted something that was going to help you all in Q4. So check this out. The Parker Rolling 45 credit card, I think, is one of the best offers in the world. With a traditional credit card, whether you spend on the 1st, the 4th, the 24th, or Black Friday, right, which we know is November 29th this year, all of that money is due on the 1st of the month. That takes your precious cash flow and it subjects it to these massive drops where you have to go off and pay all your spend on the 1st of the month, regardless of when you spent that money. But this doesn't make sense in a period where we're spending 10x the amount of money on a Friday right before the start of a month. So what Parker Rolling 45 does is kind of genius. It treats every day like its own cohort of spend, including Black Friday. And then each day is subject to its own 45-day payment term. So every day has a different due date, which means that your spend on BFCM, okay, isn't going to be due until January. So rather than having to spend all of your Black Friday money that you just earned on paying off your credit card 1 or 2 days later, you're going to be able to move that out 45 days. So you get 45-day terms on every day of spend. This smooths out your cash flow and allows it to grow steadily. And Parker will do this analysis where they'll show you what your cash balance on your bank account will look like with a traditional credit card and their rolling 45. If you're looking for ways to extend your payment terms, create more cash in your bank account, especially in Q4, and I know the other thing that happens is oftentimes we're making a big PO purchase ahead of Chinese New Year in February. This is a great way to smooth out your cash flow, take advantage of rolling 45 terms, getparker.com.
Now, alternatively to on running, one of the distressed examples I see of what businesses look like when they're in real trouble is they have what I call the 40-40-40 rule, which is you'll see the OPEX balloon all the way up to 40% of revenue, cost of delivery still high at 40%, and their CAC pushing 40% as well. And obviously then there's no room for profit at all. And it is more common than you would imagine that in this day and age following COVID, brands inflate their OPEX relative to increased revenue expectations that are never realized, and they find themselves in this peril. Now, counter to the distressed example, brands that produce massive profit almost always produce massive leverage at some point in the 4-quarter example. In this case, OPEX, or in this second example, through cost of delivery or amazing gross margin, or finally through efficiency in your marketing. Either way, every business finds a way to create leverage in one of these 3 categories to produce disproportionate profit. And it's important to understand, no business is the same. The goal isn't to try to mimic anyone else's breakdown of full quarter accounting, but to understand how your business is uniquely comprised. Maybe you're a business that's always going to have high cost of delivery. That's the makeup of your product. What that signals to you is that you need to be running at lean OPEX. Maybe you're a business that has organic audience built in and you're going to be able to drive efficiency in new customer acquisition, and you can afford to build a little bit more robust team or spend a little bit more on the product quality. Regardless, understanding how your business breaks down in these simple categories will guide your P&L towards more profitability. So what now? How can you apply this principle today to start building more profit into your business? 3 key takeaways. 1, understand your starting point. What is the genetic makeup of your unique business? Where are there going to be immovable objects in all of these categories that help to inform point two? Build leverage somewhere. What parts of these business can you create unique leverage to produce disproportionate profit? And finally, track your percentages every single month. What gets measured gets moved. And to help you with that, we've created the perfect 4-quarter accounting P&L template that you can use. Comment 4QA right now, and we'll send it to you.